ETF, index funds, and mutual funds are terms that are used interchangeably but are often mixed up. I've seen people invest their whole portfolio into one of these funds without fully understanding the pros and cons, and then having to switch over to another, which can be extremely stressful and extremely expensive. So in this video, I'm going to go over what each of them are and the key differences. So by the end of the video, you know exactly which one is the right option for you. If you're new here, I'm Nischa. I'm a qualified accountant and my channel covers a range of things from business to finance to self-development. Let's start with the basics. There are two main ways you can buy stocks. You can either buy them individually. So for example, if you're interested in specific companies like Apple, Amazon, Tesla, you can buy directly these purchases from each of these companies. So you can buy an Apple share, you can buy an Amazon share, you can buy a Tesla share, all individually. And when you buy these shares, you're buying a small piece of that company. But if your aim is to invest in loads of different companies, buying individual shares can be very counterproductive. There will be hundreds of separate transactions to make. You'll need to press order hundreds of times. You need to pay a fee every time you buy. So instead, a simpler way to buy multiple companies all at once is through investing in a fund. By investing in a fund, you get access to all the companies that that fund invests in all at once. So it's giving you diversification. So with a fund, instead of investing all your money into one company, you're spreading out your risk. You're investing a little bit in a lot of different companies. So that way, if one does badly, it doesn't matter as it only represents a small amount of your overall portfolio. Now you know the difference between individual shares and funds. Let's move on to the next layer, and that is types of funds. There are two main types of funds. There are actively managed funds and there are passively managed funds. So what's the difference and how does ETF and index funds come in? The term actively managed is exactly what it sounds like. These funds are actively managed by an investment professional. So what I mean by that is you're putting your money into a fund and then that fund has a professional that is deciding what stocks that fund owns. So their aim is to outperform the market, i.e. achieve better returns than the market average. If that doesn't quite make sense, don't worry, I'll come to that in the next part of the video a bit further. The positives, therefore, with investing in an actively managed fund versus buying individual shares is that it's much more convenient. As we've seen, it's all through one transaction and it's diversified. The downside, however, with actively managed funds is that they are expensive because actively managed funds requires someone to do the research and all the stock picking. They charge you for the work that they have to do. And on top of that, although their aim is to beat the market average, active fund managers, in fact, fail to beat their market index in most cases, especially when you take into account their fees. That's where the next option comes in, and that is passively managed funds. And both index funds and ETFs, i.e. exchange traded funds, can fall into this category. So passively managed funds are funds that don't require an investment manager or don't require someone to make all those buying and selling decisions because it just follows a fixed formula and it replicates an index. Okay, so then you ask, what's an index? An index you can think of as a list. It's a list of companies that are grouped together by a similar characteristic. You can have an index that groups companies by their sector, like the energy sector, or they might be categorized by market capitalization, so the largest companies in a specific country or even worldwide. The S&P 500 and the FTSE 100, they're well-known examples of such indexes. So the former, the S&P 500, represents the 500 largest US companies, whilst the FTSE 100 represents the largest companies listed on the London Stock Exchange. So you cannot directly invest in these indexes, but you can invest in an index fund or an ETF that allows investors to invest in a portfolio that then replicates that specific index. And because you're not paying a fund manager to make these decisions for you, the fees for passively managed funds are so much lower. Now, these indexes, these lists, they're not fixed. They are managed by committees who chooses which companies make it onto that list, and they base it on a specific criteria. So again, taking the S&P 500 as an example, a committee determines the criteria that a US company must meet in terms of size, liquidity, and other factors to be amongst that top 500 in the country. And these lists and the companies that are in there change around. So for instance, in the S&P 500, if a company no longer meets the set criteria, it will be booted out and another company that does meet the criteria will replace it. So for example, on the 2nd of October this year, there was a press release that explains how DXC Technology will be dropping out of the S&P 500 because it no longer meets the criteria and instead it will be replaced by a new company. As a result, index funds or ETFs, which aim to copy the performance of this index, will also adjust their holdings to reflect these changes. So it's as closely as possible mirroring the performance of the index. So that way, if the S&P 500 is going up by 4%, if the index or that list has been replicated properly, then the index fund or the ETF that tracks that index should also be going up by 4%. So ultimately, these funds, ETFs and index funds, they act as a tracker to give us an opportunity to get the same performance of all those companies in the index. So the similarities between passively managed index funds and passively managed ETFs are that they're both low cost because they don't have someone deciding which companies that fund invests in. They both track an index, so they're designed to mirror or just follow a specific list, and their performance will track whatever the performance of that index is. They both offer diversification, so you can invest in multiple companies all at once. And they both give you average market returns. So that's what I was explaining at the start of the video. Because they track an index, you get similar returns to how the overall market or a specific sector is performing. Now, so what's the difference then between an index fund and an ETF? You can trade an ETF throughout the day. So in the sense, it's kind of like a hybrid between a stock and an index fund. It can be bought and sold throughout the trading day whenever you want. Their price fluctuates throughout the day. Whereas on the other hand, with index funds, they have their prices set once at the end of the trading day. So whether you buy an index fund at 10 a.m. or at 2 p.m., you will get the same price. The second difference is the initial investment. So typically, investing in an index fund might require a larger initial amount compared to ETFs. With ETFs, you can start with the price of just one share, which can be much lower. And the third difference is automatic investing. Most index funds allow you to set up automatic contributions, meaning a specific amount is automatically invested at regular intervals. For example, every month or every quarter, however often you want to invest. This makes it a lot easier for consistently saving and investing. Again, you're removing the friction required to be able to do that. While some investment platforms might offer similar features for ETFs, it's much more common instead as a feature for index funds. So using an example to pull it all together, a very popular ETF is the Vanguard S&P 500 ETF UCITS. So let's break this down. Vanguard are the people who created that ETF. This can be another provider. You may be able to see iShares, for example. Then you have the S&P 500. That is the index that's being tracked, the S&P 500. And then the ETF explains the type of instrument that you're going to invest in. It's an ETF. And then you have UCITS. That's a terminology for Europe, specifically that shows that the fund has been checked and it's ready to trade in Europe. So that's it. Those are the key differences between the different terminologies. Hopefully that breaks down some of the confusion that exists with what each of them are. Thank you for watching. If you want more videos on investing, I have a playlist which I'll leave over here, and I'll see you on one of them.